Hello, everyone. Welcome to Test 3. This is Mark again. And it's CPI day, so congratulations to everyone that survived it. Tesla did okay today, nothing too great, closing at $271.99, going up a smidgen by 0.82% for the day. It was higher earlier on in the day, but we'll get to the charts in a couple seconds. Just go over the big news first, which is going to be basically the CPI report. So we'll switch over to the browser. You can see in the CNBC article, and this is the gist of it. Inflation rose just 0.2% in June, and that's less than expected. It went on to say the consumer price index rose 0.2% in June, and that was up 3% from a year ago. So the month over month is 0.2%, which is very very small, and year over year comparison is 3%. Let me go to the expectations real quick, and so you can see what was expected of that report. So here's the actual at 0.2%. This is the expected or the consensus estimate. This is the core month over month, and this is once again lower than the consensus. CPI year over year is lower by 0.1%, and core CPI, which is the big deal, is lower by 4.8%. Now, I mentioned yesterday that to have a miss on core CPI would mean that the market would rally. And the market rallied, not all tickers rallied the same way, and not all of them kept their gains from earlier on in the morning. But this was a 0.2% miss on core CPI, which is what I said basically we needed to see. A 0.1 or 0.2 would mean the market would rally. Headline being 3% compared to 3.1%, that wouldn't be much of a rally. Because there's a lot of people, maybe not everyone, but a lot of analysts and brokerages and banks expected a 3% or something like that. A 2.8 might have done it. It really might have. A 2.9, maybe. It might be up like 0.2% instead of 0.6 or 8 or something like that. So let's go back to the article with CNBC. They went on to say, excluding food and energy, core CPI increased 0.2% and 4.8% respectively, which is the year-over-year number, which is great. Now, the comp I said is easy for last year. This was expected to be really soft on a year-on-year comparison, but it was really, really good month over month as well. The article says in the body, inflation fell to its lowest annual rate in more than 2 years. Fantastic, right? It's good for us. Here's a graph that shows the disinflationary trend over the past, I would say, year or so. And this is probably one of the fastest drops in inflation in history for America. This is very, very quick. And I understand core is pretty sticky, but it is generally trending down. And this missing by 0.2% is fantastic. The article continues saying, stripping out volatile food and energy prices, core CPI rose 4.8%. The annual rate was the lowest since October 2021. And that was back then when people were saying, like, look, should we be talking about like raising rates back then? Like, no one, it should have happened. It honestly should have happened much sooner than it did. But people are talking in the 2021 area, like, yo, we need to get on this. Like, inflation's really biting. In sum, the numbers could give the Federal Reserve some breathing room as it looks to bring down inflation that was running around 9% in annual rate in 2022, the highest since 1981. This was before I was born. This is before a lot of people who are trading was born. And people who are adults and that are in the industry, they barely understand what that was like. They weren't old enough to kind of understand what the trade was like. And the real big difference, and one of the reasons why we have the faster deflationary trend, number one is technology. Technology is disinflationary. I don't want to use the word deflationary, but it's disinflationary. Maybe that's a better word to use, where the ability for AI, for instance, in this case, to provide productivity without increasing costs, it's providing an outlet for companies to spend money, and like instead of sitting on all this cash, they're putting it out into the economy. And you're going to see a lot of people buying, not people, but a lot of companies buying chips from NVIDIA and soon AMD and Avgo, which is Broadcom, which is doing really, really well. Actually, semiconductors did really, really well today. And NVIDIA made, I think, an all-time high. So Nvidia is looking to break out, which is crazy to think because it wasn't like 2 months ago that people said this thing is going to be, back at 200 in no time. But people don't understand, like, when it comes to this groundbreaking technology, like, even though like you might not use AI on a daily basis, you can understand that AI it's a lot of a more practical hype than, let's say, Bitcoin or cryptocurrency was. If you go back 2 or 3 years and you try to, describe to someone, hey, this is why cryptocurrency would be really, really great for us here in America. Now I understand outside of America, having a currency, quote unquote, that is less volatile than your local currency, it could be a boon. But the thing about it is you can barely transact in it, which is not really beneficial for a currency. Like, there's countries outside of America, and we have this perspective of a more consistent, value of our currency compared to other currencies. But there's places in Africa or South America where their government and their monetary policy just doesn't lend itself to currency that has any value. And if they were to like earn money in their currency, then immediately switch it over to cryptocurrency, ironically, to us, cryptocurrency is incredibly volatile, but it wouldn't drop in value. Like, even if it was to drop in half, it wouldn't drop in value like some local currencies in other countries. But outside of that kind of, that little niche edge case, this is AI in America and rest of the world has practical use from day one. And I mean AI in the kind of rudimentary large language model ChatGPT form. But when businesses think about AI, like, they're thinking about efficiencies and way to help themselves save costs. And that could be letting people go and having machine learning learn their job and then do their job for them without any costs and barely any maintenance costs. Or they're providing new services to their customers. But basically, the business end is going to be a boon. And who would that be for? Like, we're talking like the back end systems like ServiceNow or Salesforce. And from Tesla's perspective, Tesla's gonna make a product that will have incredibly high margin, and that's how they're going to benefit from AI. Now, you're not interacting with the AI like ChatGPT wise, but when your car eventually will start driving around for you, and I know there's this idea that full self-driving is kind of like in the clouds, but it really is. If you use it, or if you have someone that subscribes to it or has bought it for their Tesla, why don't you just go for a ride with them and just see for yourself, instead of just listening to all this basically FUD or hoopla about, we're so far away from autonomous driving. Well, is there someone really closer that can have a car that has a software to drive you around on any road in this country and not geofence into Austin or San Francisco, or who has what governments or like regulatory bodies consider level 4 driving assistance? But the reality is it's nothing like what Tesla has. And the practicality of it is that the AI is what makes Tesla it's what makes Tesla head and shoulders above the competition, because you have unlimited ability to improve because you're using vision alone through cameras to train the computer and the AI to drive the car for you. Where if you were to just use, let's say, radar systems and LiDAR, like Cruise or Waymo is doing on their cars, and you see all these contraptions on top of those cars running around San Francisco, there's really not much that they can improve as far as, the resolution of what they're driving around and understanding. It is what it is. The radar and LiDAR is just going to be that way for the rest of the world's existence. Where vision can learn anything from the evolving shapes of cars to evolving shapes in people, how they're dressed, different types of animals, and with enough information fed into the AI, and if the AI is strong enough with the compute power that would be what we're going to be 100x by this time next year, for what's going to be Tesla's Dojo supercomputer, probably like version 2, because they have Dojo up and running right now, but they're designing a new chip and they're going to manufacture the chip or have it manufactured. I think they might be using ARM to do that. And So if you ever see an ARM, if you see ARM go public, they want to do an IPO soon. Something to think about. Not financial advice though. So they're going to have immense compute power. They'll create a product that have high margin because people are going to be paying thousands and thousands of dollars for this software, and not to mention it is going to be the same software that powers the Tesla Optimus robot because it's all vision based. And that's what's really great about it is this is the type of software that can be licensed to other companies or used in different products within the Tesla umbrella or Elon Musk umbrella, really, and anything he wants to use it for, and have some type of automation, autonomy, being able to maneuver around the world is what AI is eventually going to be considered. Because when you're interacting with your robot assistant on a daily basis, it's being powered by AI. When you're typing in a computer, talking to some website, that's not really the greatest version of AI. When AI was perpetuated through movies and stuff like that, it's always was in type of a robot form, a humanoid robot form, because essentially what we're looking for is an extra set of hands. We're looking for an extra set of eyes and ears to do things for us instead of like the amount of type of automation you do with ChatGPT. Like it can maybe automate some of your, work that's done on the computer. But the reality is, do we want to live in the future? We don't want to be on the computer all the time. I mean, by the time AI takes over the world, we're using it to replace us doing things that we don't want to do anymore. But I digress. Just know that our version of AI, it's going to create efficiencies that make the economy, how do I say it? It's just going to be, if inflation is 2%, like when AI takes over, we don't even have to worry about inflation anymore. And that's what technology is about. There is no technology back in 1979 that could have drove inflation down faster. Okay, there just wasn't. There wasn't accessible consumer level technology that could reverse 17% inflation year over year, where we have that now. And essentially AI could basically do away with the idea of whatever economy is that we're in right now. Because if we have AI that can do everything and everything for us, what's the purpose of money? What's the purpose of us trading stocks out there? Why does it all matter when AI can just do everything that you're doing now, doing it better for you? There's no point. There's no point. So I highlighted another area when it comes down to the stickiness of inflation. Let's go back to inflation real quick. Housing costs. The article says housing costs, which account for a large share of the inflation picture, are not coming down meaningfully. Lisa Sturvantz, a chief economist at Bright MLS, has said, because rates had been pushed so low by the Fed during the pandemic and then increased so quickly, the Federal Reserve's rate increases not only reduced housing demand as intended, but also severely limited supply by locking homeowners in homes they would have otherwise listed for sale. Now, what does that mean? So what is the stickiness of housing? Now, number one, I think the stickiness of housing isn't just this argument where part of shelter, which is worked into CPI, is rent and home value or home sales as well. So rent is sticky because people are locked into year-long leases, right? Or multi-year leases, or just many months. So their cost is fixed for a while. Even if the market was to, like if the renting market was to collapse, you still have people who are renting at very high prices regardless. So it's not really reflective of, if someone was to rent right now, it could be, in a lot of areas it is much more cost effective to do that, especially when comparing it to buying a home because of interest rates. But yes, one of the things about the rates being at 7.7 or 8%, something like that now to buy a new home on a 30-year mortgage, is that if you were to sell your house, where would you live? Because if you were to sell your house and buy a new house, it gets kind of problematic, because if you need to get a mortgage, you're going to be paying 7 to 8% instead of the likely under 5%, under 4% that most people are in right now. They just don't, there's no mobility there. Now, trust me, whenever rates do come down, one of the things you want to look for is the people are going to want to move, right? They're going to want to either lock in some type of equity gain, or they just want to, they've been trying to move but couldn't. Think about all the type of stocks that are related to that. U-Haul, or like Pure Storage, or not Pure Storage, I'm sorry, but storage, or public storage REITs. It's going to be a very interesting time when rate cuts are on the horizon. Now, speaking of rate cuts, traders are still pricing in a strong possibility that the Fed will enact a 0.25% rate hike. And this is something I posted on Twitter and thinking that, yeah, you're going to need to expect that in July, at the end of this month, actually here, July 25th and 26th, that they're going to, which is the next FOMC meeting, the Federal Reserve is definitely going to raise rates by 0.25% because they don't like to surprise the market. When they telegraph that, look, we're doing 0.25, they're going to do it. But the flexibility is in September, maybe in September, we don't have a rate hike. Currently, we still have decent odds of a rate hike in September, but this inflation report is really, really good evidence that what they're doing is working, and maybe that they don't need to do another rate hike and they can continue to wait to see what inflation really looks like as their monetary policy takes effect with time. Now, one of the big reasons why CPI came in really low is because energy costs have decreased substantially year over year. This one highlighted area says 16.7% a year ago. We're talking about specifically about gasoline. Now, which is really good. Food prices are just 0.1% month over month. Used vehicle prices declined dramatically as well. And airfares fell 3% month on month, which is surprising. I see a lot of airfares that look really expensive, but yeah, it is what it is. Maybe it's just the routes I'm looking at. But let's go back to energy real quick and let's talk about, is there another rate hike in September? Well, one of the problems that is going to present itself in maybe the August or September release of CPI and PCE, the inflation reports, is that energy prices are a little bit more expensive over the past month or two compared to what they were for this last report. So you might see core with energy included being a little bit more expensive. I'm sorry, a little bit higher in inflation, be it month over month or be it year over year as well. So that's something to think about. And if you are a trading type of person, you can always just simply hedge that by being long energy. That is not financial advice at all, but it is what I might be doing to help myself with that situation. Now let's go to the charts. I'm sorry I rambled on so long, and that's kind of my style apparently. But let's look at the chart. Now, the daily chart is not that great looking. We opened pretty high. We opened at $276, that gap up, and sold all the way down to $272. Not incredibly awesome, but not too surprising when I keep harping on about our range. Now, this could form a pretty nice inverse head and shoulders for next week, depending on how the price action is. So what tomorrow you want to see is, I don't want to see it, but you can maybe have a quick dip into the gap. But we already did that earlier today when we sold off to 271. But if I was to draw something out, something like this would be pretty compelling going to next week. I would like to see something along those lines. I would like to have a nice positive day tomorrow, maybe start flat, go up. But we have PPI tomorrow, which is the inflation index for businesses, essentially. Their costs essentially. And if China typically has a good lead or front run on PPI, and their PPI is almost into deflationary mode. It is deflationary. Like their costs are so low and no one's buying anything still. So they're going to have a little bit of problem of coming around the bend with their economy unless we see some stimulus. So some ideas, if I was trading, and this is not financial advice, if I was doing something, going long on Chinese equities could be an outperformer than staying in a really overbought, quote unquote, U.S. equity right now. But that's not financial advice. But that's what it would be interesting to see a move like that. Like if there's a good PPI number, and then essentially you'll see a good setup somewhere. Maybe it'll end somewhere around there. 280, 282 for the week. That'll be interesting because it would make the next week get you to a point where it's a pivot, meaning that it can go either way. Does it reject here and on a bigger time frame make a double top? Very possible. Or simply it's just an inverse head and shoulders and it continues to go up. But here's on the minute chart, Oh, sorry. Let me delete that. On the minute chart, you're seeing the price action for Tesla, and you're seeing this large gap up. This was a gap up of something like 2.5%. It tried to find a base here, like a lot of other tickers and indices and stocks. It tried to find a base, and it kind of did. It's found a lot of interest in this area, the 271.50 to 272, and it closed at basically 272 right here. So is it all that surprising? It's not, because people are looking for an excuse to de-risk themselves for next week's earnings. So if it was open at 276, you'd have a lot of people wanting to sell at that point because they want to get out and think about getting back in later, because they don't want to expose themselves to risk during the report release next week. And you're going to see, anytime you get a pump like this, for us to get back to 282 by the earnings release, it's gonna be a tall order. You need to have a lot of good news. Otherwise, we're filling gaps down below, which is never really great because there's a lot of gaps. But if tomorrow you see yourself in the gap at any time, but it never fills, you can be pretty confident until next week that, because I don't know if there's really gonna be a lot of planned data releases or economic report drops that would really affect Tesla specifically. There could always be specific news to the company that can affect the price action. Today we had an upgrade from I totally forgot, but it didn't really move the stock. Like it moved the stock, like CPI moved the stock, but it didn't help it sustain any bullishness at all. Like this is not that bullish. This is pretty bad. But it's green. I mean, we'll take it. But this pattern, if I saw this pattern on any other ticker, I'd be like, okay, so test the low again. It's going to fall through eventually, because it's not making. It's basically going in a smaller time frame downwards. It's not making new highs. Did this high? See, this high is even lower. So there was no new highs. They weren't taken out, so it wasn't all that impressive of a chart. Now let's compare that price action to the S&P 500. Not all that dissimilar. All these tickers try to find a base and kind of bounce off that a little bit. The close on the S&P 500 wasn't too bad, and on a lot of tickers, the close is not bad at all, considering. But yes, I understand. We are up. We gapped up, and we are up, and the S&P 500 closed, 0.7%. That's pretty good. Let's look at the NASDAQ. The NASDAQ didn't have a strong base like Tesla or the S&P 500 did. It had a deeper dip, which was a nice buying opportunity, because this move was pretty substantial. If you're going short, that was basically 1%. And if you were going long from the lows in this consolidation, you would have seen anywhere from 0.6 to 0.8%. So that was a really good move. And you can see QQQs, they are being bought up a little bit after hours. And, one of the things about this day in trading is, even though it was a good report, and obviously these are gapped up, price action, and yeah, all these things closed pretty positively. The reality is we still don't understand what's going to happen on Friday and Monday for the NASDAQ. Like, what's going to happen? Like, how much are these tickers going to need to sell? Or do they already price in that movement that sell was on Monday? And we're not going to see a drop in the things like Apple, Tesla, Microsoft, Google, Meta, Nvidia, and Amazon. Like, those are such heavy weights in the S&P 500. If there was like this forced sell from all the ETFs in the world that track the NASDAQ, how many shares is that? What happens to the mega caps? And that's why I think there's some muted performance, especially on Tesla. It has that going against it, along with earnings next week. But we're still in the range. So if you sold calls, you still feel pretty good about it because you're burning theta all day long, right? Nothing's really happening, and this is expected. So I really want to show it to you again. This is really, really expected. Let me clear all these drawings off. But we're in a range. We're not getting out of this range, and we have a couple more days left. So there wouldn't be a real reason to expect. If you want to go long, you probably don't want to stay long after 280 something, because it's just not gonna. The chances of it wanting to bull, it's just pretty low. Let me draw the range. So it ends on earnings. So this is our range so far if you don't include the gaps. And so if you get to 283 on any day before earnings, like, I mean, if you're long on an option, or if you're just swinging shares or something along those lines, that's a good consideration for a take profit. Now, we don't know what the next couple of days is going to be like. Maybe there's going to be some great catalysts that'll drive the market up, and maybe the market didn't want to move today because it doesn't want to show its hand and it wants to prepare for the move tomorrow. And you'll see that sometimes where there's a CPI release, and on the Thursday thereafter, there's a bigger move because they just want traders just want confirmation that the CPI was great, and the business perspective is still healthy too. And then you can go up a little bit more on CPI and PPI results being both in. Jobless numbers are coming out tomorrow as well in the morning, same time, 8:30. So it's going to be really interesting how that works out. I like to see a PPI with a beat or a miss technically, and I would love to see Tesla go up more. I want Tesla to go up more, but we've been talking about this for weeks, and it's just not going to. It's not going to get out of this range and make a higher high on a larger time frame. Now, to be fair, if we were to draw a trend line, like the trend line is suppressing that range, and if I was to draw, if you like horizontals over diagonals, you're kind of seeing confluence that it's going to be really hard pressed to get into 290. Like by the time earnings starts, even on a good, if you're lining up earnings with the downward trend line and the previous highs from September of last year, yeah, you're at that 290 and a half. And that's going to be a very, very pivotal point. We were looking at charts like this with Apple, where we're like doing a trend line, and oh my gosh, like the trend line's at the moving average and blah blah blah. I'm like, well, this is all that as well. Like this is going to be, charting. You can have your own opinions about it, but this will be a very, very important point by the time earnings is released. That if you were to see us at 290, don't be surprised. Like that makes sense. Like we've been thinking that is a maximum range. That's the maximum highest price on a range that Tesla's going to have, just due to the consolidation that I've highlighted in other parts of the chart. After the moves, there is a consolidation, and this is a typical consolidation. Like this is a 36% consolidation. That's a lot, right? But it did that for months. So going from the bottom of our range to the supposed highest possibility is 21%. And it's not all that different really from the other ranges. This is 20%. So that would make sense. Just a tight 20% range. And I would like us to be here. And because that would make sense for the market makers. Like if you are sitting here at 290 and the report is bad, and then it rejects off the downward trend line, and it would make sense to a lot of people who chart and trade. Like, yeah, like it didn't want to show an uptrend on a larger time frame. On a smaller time frame, obviously we're in an uptrend, but on a larger time frame, if it's sitting here and rejects cleanly off it, then it's continuing its downward trend line, and we will flounder for months trying to get back up there. It would be something like this. Like, how long is these two peaks from each other? Let's measure these two peaks. It's 2 months. And so it wouldn't be surprising if we see something, if we reject off the downward trend line, that we would see, this is 3 months. So 2 months and 3 months of consolidation before we can even try to, again, get back to the trend line. What would that look like if this is the end of the consolidation? If we map out, this is 63 days, like you would see the trend line again at around $277. It would I'm not sure this is actually going to happen, but let's say we get up to that kind of intersection point. Let me draw it out. It will look like something like maybe like that, or breakthrough, something like that. It would be excruciating for us, but it would make sense, with Tesla's. It's got a lot going. I mean, it's got going against it for next week's report. Like I talked about auto gross margin a lot, but that's really going to be the main issue. we need to see 19%. Just like I told you guys, for us to bull today, we needed to see a beat on core or miss on core by like 0.2 or 0.1%, and we got 0.2%, which is exactly what I thought would be required to really do really well. So Tesla's kind of flat. It's not really going anywhere. I don't expect it to go anywhere. If you're long an option, I would say this is just what I would do for myself. You probably don't want it to expire this week. Give yourself time to let it play out, and so it doesn't become worthless if things go really, really bad. If you're buying options for earnings next week, just understand that you might see an increase in value. So kind of structure your trade in a way you can kind of reduce your risk. As we get closer to July 19th, which is our earnings report for Tesla, your options will become possibly more valuable just from the mere implied volatility increase. So as you get closer to your earnings report release or any other event for a ticker, if the volatility goes up, of course, the value of your calls or puts might go up or be unchanged in weird price action where, today, for instance, we have JP Morgan coming on soon, where my calls and my puts for JP Morgan, even though the price was going up and down, they weren't changing at all. Ironically, when the price was going up, sometimes my puts would actually go up in value because volatility is changing or increasing due to the event, which provides a lot of unknowns. So if you're long in options or multiple options, you might see your calls, let's say if you're bullish, your calls will get more valuable even as the price action doesn't really change. And that might give you opportunities to get out and realize profits at that point, or kind of scale out of it and stay long, but reduce your overall exposure because there is a lot of disappointment when it comes to how Tesla reacts to an earnings release, where you would think that Tesla would be very volatile, but sometimes the move is so like the market would anticipate that an earnings move would be like 10% on Tesla, but if it's 8%, you're not making any money unless you're selling calls. You're not making any money at all. And so that becomes pretty problematic where it's like, okay, they expect Tesla to be very, very volatile, but the move isn't a lot. Like if that was a 10% move, 9% move, and the market expected 10, even if you had puts back in October last year, you would lose so much value due to IV crush, implied volatility crush after the earnings report, that even a 9% move might not make you any money at all. And actually, you might actually lose money. So it's really scary to be long Tesla via options because they price in such they price in such a big implied move with their options, meaning like there's a certain range of options that get more expensive. They're more affected by the IV implied volatility. And if the move is inside that really, I would say up and down 10% from that particular area, or that from the current pricing 10% up or down, if the move is not getting out of those calls going above that 10% and puts going below, I think it's a bad it's going to be a bad trade, especially if it expires end of next week. Time is really important because the more time you have in your option, the more the less volatility. So the further out your option is, the less volatility it has. Now, granted, a strong 10% sell-off will still really hurt your calls, even if they're dated out 3, 4, 5 months, 1 year. They would still hurt a lot. So I'm not saying it absolves you of all risk, but it kind of lowers your volatility, but also it gives you more time for the price action to kind of work itself out, where you have more choices. Like, should I get out? What do I do with it? Because they're not completely worthless, which short-dated options were. But of course, short-dated options might be useful depending on how the price action looks next week. If Tesla sells off over the next week, then having a short-dated call that expires 2 days in 2 days, like if you bought on Wednesday afternoon and expires on Friday of next week, then yeah, it kind of makes sense because it's being set up for it's been de-risked. And so the potential for upside might be greater than downside. But where it is now, where it's being pinned in this area, if this is the area it gets pinned in, this is me a tough to go. It's gonna be a tough long. It would be easier short. because it's kind of sitting at that downward trend line. And unless the earnings report blows you away, and it needs to surprise in some way. It needs to surprise with the margin, or it needs to surprise with overall operating margin. Like maybe energy is doing really good and services are really doing really good, or they reduce their costs and they're much more efficient now. It needs stuff like that. It needs to be a big surprise, because if you're sitting on this downward trend line for Tesla next week, it's going to have to beat really, really well some way or somehow. Well, that's it for now, guys. Thanks so much for listening. Sorry the video's going so long, but I'm really happy that you listen all the way up to this point, and I'll have another video out for Tesla's price action tomorrow. Have a good night. Bye.